So hello all my dear students, I hope you all are doing good. So here we come today to review the CA Final Direct Tax Paper 7, May 2023 for all our South India students, especially in full English. So I have already done my review for the Hindi version, which was uploaded 2 days back. I got a great review over there. And there I got a lot of requests from the South Indian students that, sir, please review the paper in English also. So here I come in front of you all to review the paper in English also. So first of all, I would like to give a basic review about how the overall paper was. The overall paper was above average, but below difficult. It was somewhere near to difficult. It was not extremely difficult. It was above average. Some part of the questions were very simple. Some part of the questions were out of the world. I'll be speaking about all of them one by one. Don't worry. But overall, the paper was not very easy also. The institute has raised the bar for direct tax. The institute wants to teach you a lesson that don't take direct tax lightly. You have to take the subject like direct tax very, very seriously. If you want to learn direct tax in detail, in practical life, you have to learn 298 sections. There are more than 1 lakh circulars. There are more than 85,000 to 1 lakh High Court and Supreme Court judgments. You have to do all those things. If you want to do what? If you want to become an expert in income tax. And what do you feel as a student? You can become an expert of the income tax just by following what? Just by following some summary books, some revision videos. You can become an expert in that. It might help you. It might help you. The revision videos might help you. The summary books might help you. All these things might help you, but that cannot be a replacement for a great paper or for a difficult paper. For a difficult paper, your concepts have to be very, very strong. And this is what we do in our batches. We focus more on the concept rather than what? Rather than by hearting the stuffs. Concept is very important in direct tax. You have to be very focused with the concept. So without wasting any further time, let's start with the discussion now. According to me, the overall paper review was, it was above average, somewhere near to the difficult level. Not very difficult, it was near to difficult, but because they have asked some provisions from very minutely by targeting some minute part of a particular provision. They have not asked a provision directly from the, you can say the provisions were asked between the lines, but you have to read between the lines. So without wasting any further time, let us start with the first question. The first question is about, I don't know about the MCQ. What was the MCQ? I don't have the MCQ list. If I have an MCQ list in front of me, I can easily answer them, but I don't have an MCQ list in front of me, neither anybody would come to know. MCQ is like God. MCQ is like God. That we have to believe that it was there, but nobody has seen that except the students. Only students can see the MCQ. Nobody else, they never ever release also the MCQ booklet, which was asked in the examination. They never do that. I don't know why, what fear them to release that particular MCQ booklet. They should release it for the betterment of the students, for the betterment of the future students, but they are not doing it. So nevertheless, we are more focusing now on the descriptive part. MCQ is not there in our control. So let's talk about the 70 parts review, 70 marks part review. So very first thing is the question on your total income. And the very first thing over here, the assessee is a manufacturer over here. And you have to compute the total income of the assessee. You're not supposed to follow anything like 115BAA, 115BAB. You're not supposed to follow MAT and all. You're supposed to just compute total income. You're not supposed to even compute tax liability over here. You are just supposed to compute the total income and leave it. Okay. So let's see what all adjustments have to be made. The profit is 1 crore 25 lakhs after debit and credit of the following items. The first thing is, they are making a payment of advertisement expenditure to a director, sister concern of a director. So it is a related party and you are making a payment of 1.6 lakhs in cash. So you are making violation of 2 sections. We have done similar adjustments in class also. That if you are making excess payment to relative in cash, then you have to first follow 48.2 and then 48.3. So first in 48.2, you have to disallow the excess amount. How much is excess? You have paid 1.6. The market value is 52,000. Therefore, excess is 1,08,000. 1,08,000 has to be disallowed. Now, if the balance amount is more than 10,000, then disallow under 48.3. The balance amount is 52,000, which is more than 10,000. Therefore, the balance amount will be disallowed under 48.3 because it is paid in cash. So this is what the adjustment of first question is all about. Next adjustment, you have made some repair of plant and machinery. And you have made a repair of 1.8 lakhs towards replacement of the worn out part of the machinery. Now you can make an assumption that this replacement is a capex. Okay. If it is a capital expenditure, then you have to add back this 1.8 lakhs. You have to add back this 1.8 lakhs and then take 15% normal depreciation, assuming that the asset is used for more than 180 days. So you have to make a lot of assumptions over here. They have not mentioned the date of put to use, etc. over here. So the first assumption which you can make it is a capital expenditure. Okay. Because you are replacing the worn out part of the machinery, it is a capital expenditure, and if it is a capital expenditure, you have to add back 1.8 lakhs. You have to take depreciation of 15%. Okay, and then reduce 15%. Apart from that, you can also claim additional depreciation of 20% because it is a manufacturing associate. That is a debatable one, but because you are not purchasing a new machinery, that is a debatable one. Because you are not purchasing a new machinery, instead you are purchasing what? You are replacing the worn out part of the existing machinery. So whether to take the additional depreciation or whether not to take additional depreciation, it is a debatable issue. If you have taken, then also it is well and good. If you have not taken, then also it is well and good. You have to write a proper assumption over there. So you have to write a lot of assumptions over here. Okay, next one is a similar adjustment which we have done in past RTP mock tests and exam papers, that till 2021-22 the company used to include interest in the cost of fixed asset in the stock. So till last year, that is till 21-22, the company used to include the interest in fixed asset in stock. But from 22-23 onwards, they have followed the ICI accounting standards and they have excluded interest from the stock, which is the correct treatment, and they have also decreased the profit accordingly. So everything they have done correctly. So forget about that. Don't give any effect. So they have done everything correctly now. So why you have to give any effect for the same then? Everything is done correctly. Same adjustment we have already done in our RTP, MTP and mock test paper and past paper discussion. So don't give any effect because the company has already done everything correctly in the current year, and they have also adjusted the profit in the current year. That's it. You don't have to give any effect. You just have to write a note on the same. Next, there was one executive, Mr. Q, who was on business trip and he died over there. So there was one employee who was on business trip and he died over there. So the company paid some voluntary gratuity to his family. It will be allowed as a deduction under 37(1). It's allowed, nothing wrong. He was an employee and you are compensating your employee, so it will be allowed as a deduction. There is nothing wrong in this. Okay. Next, capital expenditure of 1.8 lakhs incurred for the purpose of promoting family planning. Okay. So what has to be done? Now, capital expenditure of family planning is allowed how much? 4/5 has to be disallowed because only 1/5 will be allowed in the current year. So 4/5 will be disallowed. So out of this 1.8 lakhs, 4/5 will be disallowed. So you have to add back 4/5. 4/5 will come to how much? 1 lakh, somewhere around 44,000. You have to add that back. Okay. Next, retrenchment compensation for the unit which is closed down. So you are closing down one of the unit and you are making so you are removing the employees from the company. So you are making some payment to the employees in the form of retrenchment compensation. That will also be allowed. There is nothing wrong in that. Okay. That will also be allowed as a deduction to you. Now the next one is a very intelligent adjustment. Pay absolute attention. Okay. Now you have taken a loan from the bank. Pay attention. The loan is outstanding to the extent of you have taken a loan from a cooperative bank. The loan is outstanding to the extent of 4 lakh, sorry. And there is outstanding interest of 1 lakh. Now the bank has waived the entire 5 lakh rupees for you. So now what will be the deemed income? Be very careful. This 4 lakh which you have taken as a loan, it is for working capital requirement. Therefore, it is a trading liability. And this 4 lakh which is waived by the bank, it is a remission or cessation of a trading liability. Therefore, this 4 lakh will be considered to be what? As your income. So let it be part of PGBP income. Now what about 1 lakh rupees interest? This is also waived by the bank, but this cannot be considered as your income because in earlier year, this was not allowed as a deduction to you. Because in earlier year, as per 43B, this would have been disallowed. So because it would have been disallowed in earlier years, now you cannot again make that as an income. If it would have been allowed in the earlier year and then if it would have been remitted by someone, then it could have been what? An income. So what is the treatment of this? This 4 lakh is a remission and cessation of a trading liability. Let it be part of PGBP, but this 1 lakh is not going to be taxed because you have already added back that to your income in the earlier years on account of non-payment as per 43B. Therefore, this 1 lakh should be reduced from your PGBP. You will not be chargeable with tax on this 1 lakh rupees. Okay. Next is a very simple one. It is based on section 36 subsection 1 clause 4A, which says that if an employer contributes to the pension scheme of an employee, then it is allowed to the extent of only 10% of your basic and DA in terms. So you are paying how much? 12% of basic and DA in terms. But it is allowed only to the extent of 10%. So add back 2%. 2% will come to 50,000 rupees. So you have to add back 2,000 rupees over here. Okay. Next one. You are providing some mark to market loss. That will not be allowed. Why? Because as per section 36(1)(18), only the mark to market loss which is as per ICDS is allowed. Mark to market loss which is other than ICDS is not allowed, not allowed, not allowed. Therefore, this will not be allowed. Similarly, there is a gain. That gain is settled in the next year in 23-24. So you are not supposed to do anything with that gain. Okay. So forget about that gain. That gain is settled in the next year. Next, there is a provision for gratuity of 4 lakh. Add back as per 40A7. Provision for payment of gratuity is added back. What about the gratuity which is actually paid? The gratuity which is actually paid will be allowed as deduction. So you have to add back 4 lakh and you have to reduce 2.75 lakhs, and that is the treatment which you have to follow. Next, you have taken some loan from a private limited company in which you hold 16% voting rights. So if I hold 10% or more voting rights in a private limited company which is a closely held company, and that closely held company gives me a loan, then that is a deemed dividend. And because it is a deemed dividend, it will be taxable under IFRS. How much? But the deemed dividend cannot exceed the accumulated reserve. How much is the accumulated reserve? It is only 1 lakh. Therefore, the deemed dividend will be only 1 lakh, 1 lakh and 1 lakh. Okay, check it please. Next is a very important and intelligent adjustment which is based on amendment made by Finance Act 2022. So you have given some iPhones to some of the distributor as incentives. So if you give some incentives to your distributor, then you have to deduct TDS as per 194R amendment. As per 194R, if you give any benefit or perquisites to your distributors, that is also mentioned in the CBDT circular clarifying 194R position. It is mentioned over there also. You can go and check over there. Therefore, it will be taxable over there. It will be taxable over there in the hands of the other person. And at the same time, you are supposed to deduct TDS. And because you are not deducting TDS, 30% of this will be disallowed. And last but not least, you are making some payment of 3,50,000 to approved electoral trust as RTGS, by RTGS. So by RTGS, it is allowed. But still, in PGBP, it will be disallowed. But under Chapter 6A, it will be allowed as a deduction to you. So if you see this question properly, it's a very, very basic question, nothing great as such, except 2-3 adjustment. Rest of the things were very simple. Okay, just go through it once and then we'll move ahead with the next one. So let's move on to the next question. The next question was purely based on some recent amendments which were made by Finance Act 2022 as well as the previous Finance Act, that is Finance Act 2021. Now, the first question over here is question number 2A1 is on computation of total income. Again, a small question. The assessee is 34 years old. He is a salaried employee. Now, you are not supposed to follow 115 BSc and all. Okay, so you have to compute as per the normal provision. And you have to just compute the total income. You are not supposed to compute the tax liability over here. Okay. So the first thing which you are going to do is 23 lakhs is the gross salary. Take 50,000 deduction, standard deduction, which is generally allowed to a salaried person. Because you are not following 115 BSc. If you would have followed 115 BSc, this 50,000 would have not been allowed. Then you have a business loss. This business loss cannot be set off against salary. Not allowed. So you have to carry forward this business loss under section 72. Not allowed. Similarly, there is a short-term capital loss. This also cannot be set off against salary. In fact, capital gain loss can be set off only against capital gain income. It cannot be set off against other income. Therefore, this should also be carried forward under section 74. You should write a note for each and everything. Now the next point is based on the amendment made by Finance Act 2022. So you are buying some virtual digital asset. So you have to apply 115 BBH. So you are buying for how much? 1,000. This is the cost of acquisition. Sale consideration is 1,300. Now it was purchased in 2022 and it is sold in 2023. Therefore, it is a short-term capital gains. Now, will I get the deduction of this transfer expense? No. You are not going to get any deduction of transfer expense because in virtual digital asset, you get only one deduction and that is cost of acquisition. That's it. So your sale price is how much? 1,300. Your cost of acquisition is how much? It is 1,000. Therefore, 300 rupees per Bitcoin will be your multiplied by 1,000 Bitcoin will be your total gain. That will be 3 lakh rupees. Now, can I set off this loss against this income? Not allowed. Against virtual digital asset income, no loss. No loss can be set off. Okay. So this is how you are going to compute this question. It was a simple question, nothing great as such. Now the next question has a lot of information which is missing over here. Okay. So what are the information which is missing? I am telling you in a while, don't worry. So there are three partners. This question is on 9B and it is on 45.4. So L, M, N are three partners, out of which L is retiring. L is retiring on 27th of July 2022 after his retirement. Business of the firm will be operated by M and N. Account balance of L on the date of retirement is 20 lakhs. There is no revaluation in the books of the firm at any time. Now there are following three things which are given to L to settle his account. The firm is giving him 1 lakh rupees cash. The firm is giving him stock in trade. The firm is also giving him some land at Kota. Now you are supposed to compute the taxable income of the firm. They are also giving us some indexation data over here which will be useful to us. First of all, 9B. 9B is attracted in case of dissolution and reconstitution both. Okay. So here in this question, what is happening? One partner is going. So therefore, it is a case of reconstitution. It is not a case of dissolution. So in 9B, what all thing comes? When a firm gives to partners stock in trade or capital asset, then 9B is attracted. 9B is not attracted for cash or money. For cash and money, 45.4 will be attracted. So the firm is giving SIT. SIT of how much? You have to take the FMV of the SIT as the sale consideration. And the cost of the SIT is given in the question is 1,20,000. Therefore, 80,000 rupees will be chargeable in the hands of the firm as what? As its PGBP income under section 28. Okay. This will be the PGBP income of the firm. What about the capital gains? The firm is also giving capital asset. What is the capital assets? FMV. The capital assets FMV, the land's FMV on the date of transfer is 17 lakh. The book value is also 17 lakh, but that is not relevant. The FMV of the land is 17 lakh. Therefore, I am taking 17 lakhs over here. What is the cost of the land? It is 1,10,000. How I got that? Because you bought that land in 1998, 1999. That is before 2001. So you have to take the FMV as on 1/4/2001 or actual cost, whichever is higher. Okay. If stamp duty value would have been given, then that would also be compared as on 1/4/2001. Do you remember that? For land and building, you have to compare your FM with the stamp duty value, but unfortunately, in this question, stamp duty value is not given. So forget about that. Compare the cost with the FMV, whichever is higher. Therefore, the higher amount is 1,10,000 multiplied by the indexation of 2022-23 divided by the indexation of 2001-2002, that is 100. This will complete your 9B. Okay. Now, in the Hindi version, I have not said this, but I am saying it now. I thought that is not important to say. Generally, what happens, whatever is the tax which is going to come over here, okay, whatever is the tax which is going to come on this 80,000 rupees, etc. Okay, you have to allocate that tax to what? You have to compute that tax, and then you have to allocate that profit to what? That profit to the all the assets. Okay, you have to allocate that particular thing to what? To the partner's capital account. But unfortunately, in this question, they have not given us what? The PSR of LMNN. What is the PSR of LMNN? It is not given. So you can write in the question an assumption. In the absence of any information about the PSR, we are ignoring this treatment. Because it's just a 4-mark question, yeah. Who is going to do so many things for 4 marks, yeah? First, you are computing 9B SIT calculation, then you are computing 9B capital asset calculation. Now I am going to compute 45/4 also. You can make an assumption that this 20 lakhs is after making an adjustment of the profits which is attributed out of this 80,000 rupees. You can make that assumption. That is allowed. There is nothing wrong in that. They should have given PSR otherwise. Or otherwise, they should have increased the marks to 8 marks. Now, what should be done in 45/4? 45/4 is very simple. A is equal to B plus C minus D. What is B? B is the money received. What is C? Fair market value of the capital asset received. What is D? This should be the adjusted capital, actually speaking. But even if you take that 20 lakhs, I think so, I say I will give the answer correct. Assuming that this 20 lakh is after making the adjustment of the profit which has been generated over here. Okay. So this is what this question is all about. Let's move on to the next question. The next question is based on your non-resident taxation. There is a foreign company over here who is entering into an agreement with an Indian company for providing certain services in India. Okay. And those services are in the nature of what? Are in the nature of fees for technical services, more or less. So if a foreign company is providing some services to an Indian company in the nature of fees for technical services, what has to be done? First of all, they are providing some 3 crore rupees services for offshore services and 2 crore rupees for onshore services. So total they are providing services of 5 crore rupees. Now, we are supposed to give the tax implication in India of the above transactions, assuming that they don't have any business connection in India. Now, we all know that for FTS, we don't need any business connection. For FTS, there is no need of any business connection. Therefore, the FTS is chargeable in India just because it is utilized in India. If the services are utilized in India, FTS is charged in India. Is the service utilized in India? Yes, it is utilized in India. Then it doesn't matter from where it is rendered. Even if it is rendered from outside India, there is a specific explanation in section 9 which says that even if the services are rendered from outside India, but if it is utilized in India, it is deemed to accrue or arise in India as per section 917. And therefore, this 3 crore rupees which is paid in the bank account of ABC, it will be taxable. Okay. And it will be taxable at what rate? It will be taxable at 40% because it is not written anywhere that this FTS is what? This FTS is, there is an agreement with central government and it is approved by central government. It's not mentioned over here. So you have to tax this at 40%. Similarly, for this 2 crore rupees, Indian company is not making the payment in money, but they are giving 6% debentures. So this 6% debentures is also a consideration. So on this 2 crore also 40% tax will be imposed. 115A cannot be imposed. For 115A to impose, you have to apply what? You have to apply what? You have to check in the question. We have done a lot of questions like that. You have to check in the question that the assessee is entering into an agreement which is approved by central government. There's nothing mentioned like that in this question. Therefore, it will be taxed at 40% flat. Okay. Now, because we are issuing debentures on 1st September, the other person, that is the ABC INC, will also be liable for what? Earning. They will also be earning interest at the rate of 6% on 2 crore for how many months? For 7 months, because it is issued on 1st September. So for 7 months, they will earn interest also. That interest will also be chargeable at what? 40%. That also cannot be covered in 115A because that is not in foreign currency, that is in Indian currency. So that also cannot be covered in 115A. So these are the tax implications which are there in this particular question. Okay. I am going to the next question, which is based on taxation of trust 3A1. 3A1 says that there is a public company who has created a charitable trust exclusively for the benefit of public. Okay, be very careful. Now, it is granting some interest-free loan to its company's employees in order to enable their children to pursue higher education as per the objects of the trust. The question is, the assessing officer considers this as being covered under 13(3) and proposes to withdraw the exemption from tax granted to the trust. So the question is this transaction covered in 13(3)? First of all, this transaction is not covered in 13(3). Why? Because 13(3) is applicable when the trust provides benefit to certain specified persons. Now, if you see the list of the specified person, it is nowhere mentioned that the employees of the company can be considered as a specified person. Nowhere it is mentioned. Now, the very stand taken by the assessing officer itself is incorrect. The very stand taken by assessing officer itself is incorrect. 13.3 cannot be made applicable. So the question of withdrawing the exemption or doing all other, applying all other consequences on the assessee does not arise only. It doesn't matter. It doesn't matter. It doesn't matter. Okay. So be very careful over here. So this section, as per me, the answer to this question would be section 13.3 is not applicable. Therefore, the action taken by the assessing officer is not tenable in law. It's not correct in law. Now, the next question is a very simple question. We have done this a lot of time. That there is an educational institution whose annual receipt is 2.4 crore and there is also an hospital whose annual receipt is 2.5 crore. The total receipt is not exceeding 5 crore. Therefore, are they liable to take registration to claim exemption? No, no, no. They can claim exemption even without the registration. For them, registration is not mandatory. We have done a lot of questions like this in the past RTP, MTPs and past paper session. So, if you want to claim, if you want the benefit of this, you can take the exemption under 1023C without doing all these things. Okay. Next one is a very, very, very intelligent question. Be very careful. There are a lot of people who have made a lot of mistakes over here. Okay. The very first mistake is the very silly mistake that people have made over here. Sir, what is that silly mistake? Mr. Rizvi is an Indian resident, aged 35 years. And he works in a very oil field. So first of all, we are going to find out his residential status. So he used to be staying out of India, but in the current year, on 1st July 2022, he came to India because of some personal problem. So if he come to India on 1st July 2022 till 31st of March 2023, he will definitely be resident. But is he ordinary resident? No, he is not ordinary resident. How? How is not ordinary resident? Because the data of the last 7 years, the data of the last 10 years is not given. So it is very fair enough to assume that he was not present in India for the last 10 years and 7 years. He was not in India for the last 7 years and 10 years. Because the question, I am very clearly saying, question doesn't clearly say that for how many days he was there in India. Question doesn't clearly say that in the last 7 years, whether he was there in India, in the last 10 years, whether he was there in India. Question doesn't say that he is coming to India for the first time. Question doesn't say all these things. But it's fair enough to make an assumption. What assumption? That he was not in India for the last 10 years. He was not in India for the last 7 years. Question doesn't say that he is coming to India on 1st July for the first time. If the question would have said like this, it would have been very clear that he was not there in India in the earlier years. Question doesn't say that also. So let's assume that he was not there in India. That's it. Otherwise also you can assume. Then you have to make a very long assumption that he was there in India. Then you have to make one more assumption that he was there in India in the last 7 years for 730 days. Then you have to make one more assumption in the last 10 years. He was there resident in 2 years. There are a lot of assumptions you have to write. So it is better to make an assumption that he was not there in India in the last 10 years. That's it. Therefore, he is RNNOR. And here the real catch is, if a person is resident and not ordinary resident, then which income is taxable? Income which is received in India or deemed to receive in India or accrued in India or deemed to accrue in India. And in case of business, if the business is done outside India but controlled from India, then it is taxable. Only those incomes are taxed. According to the residential status, the income will go. Therefore, the very first thing which cannot come in his total income is the salary which he has earned in the first 3 months. April, May and June, he was in outside country, na? Where he was? He was working in country S. April, May and June, he was in country S. That income cannot be taxed over here. Why? Because that salary income cannot be taxed if it is accrued outside India. Assuming that it is received also outside India, we have to assume that also. There are a lot of assumptions that we have to make in this question. They have not made the question very clear. This paper, this entire paper, in fact, there are a lot of places where you have to make a lot of assumptions. So therefore, here what has to be done? Here we have to assume that it was received also outside India. Therefore, for RNNOR, this is not taxable. Second thing, he has also let out some property in country S. So this property rental income is accrued outside India. Again, you assume that it is received also outside India. Therefore, it is not taxable in India. So what is taxable in India? This profits from consultancy business is taxable. This fixed deposit is not taxable. Again, you can assume that it is received outside India. You can also assume that it is received in India. Accrued, it is outside India only. This salary is accrued outside India. This rent is accrued outside. There is no doubt about accrual. This FD interest is accrued outside India. There is no doubt about accrual. There is a doubt about received. Assume that it is received outside India. Forget about it. Don't make it lengthy unnecessarily. If institute is playing with you with assumptions, now you also play with assumptions. So if you start to assume that it is received in India, then you have to compute all those things in India. Then you have to compute double taxation relief also. But if you assume that it is received outside India, then you don't have to assume all those things. You don't have to assume anything over here. Check. Saving bank interest, you will get 10,080 TTA and dividend from Indian company will be taxable. Then 48,000 Mediclaim, only 25,000 will be allowed because the assessee is a resident and he is less than 60 years. For parents also only 25,000 will be allowed because the parent is no doubt senior citizen, but parent is non-resident. So if the parent is non-resident and senior citizen, then only 25,000 will be allowed, 50,000 will not be allowed. Okay. And after that, you are supposed to compute the tax. Don't compute what? Don't compute as per 115 BSV. Forget about it. Okay. Now, next question is a very, very, very intelligent question, which is based on TDS. Okay. Pay absolute attention. This question is based on TDS now. Now, there is a buyer over here and there is a seller over here. Now, this seller is selling to the buyer. Pay attention. Some scrap. Now, generally, if I am a seller, you are a buyer. And if I am selling some scrap to you, then I am supposed to collect TCS at the rate of 1% under section 206C subsection 1. This is the first thing that you have to keep it in mind and you have to write in the exam. Second thing, I am a seller, you are a buyer. So I am selling you scrap. So I will collect 1% TCS. But you as a buyer, you are saying what, you know? You are saying me that I am buying this not for trading, but for manufacturing or for power generation. Then I am not supposed to collect TCS. This is an exemption which is given under section 206C subsection 1A. This is an exemption which is given over there. Now what to do? So accordingly, this is what it is happening over here. I am a seller, I am selling you scrap. But you as a buyer, you are giving a declaration that I am using that scrap for the purpose of manufacturing. I cannot collect TCS. But in that case, if you as a buyer and if your last year turnover is more than 10 crore rupees, and if you are making a payment or credit to me of more than 50 lakh rupees in the entire year, then you as a buyer is liable to deduct TDS. That's what it is happening. Check. The seller is not liable to collect TCS because the seller is exempted, but the buyer's last year turnover is C, more than 10 crore rupees. And the buyer is buying 55 lakh rupees goods, which is greater than 50 lakh rupees. Out of which you have made a payment of 45 lakh. It doesn't matter. TDS under 194Q is applicable on credit or payment, whichever is earlier. So you have made a credit of how much? The buyer has made a credit of 55 lakhs now in the name of the seller. Even though he has paid only 45,000, but the credit is of more than 50 lakhs now. Therefore, on 5 lakh rupees, I am supposed to deduct TDS. The buyer is supposed to deduct TDS. Check it, please. Beautiful question. There is a CBDT circular on this, which we have done it in class in fast track batch and regular batch, both the batches. Check it once. Now, the next TDS question is also very, very intelligent. There is a person who is providing some services, and when he is providing some services to the client, that services are in the nature of consultancy services, technical consultancy. Okay. In the nature of what? Those are in the nature of technical consultancy. Now, be very careful. Now, if the services are provided in the form of technical consultancy, then the payer has to deduct TDS at the rate of 2% because in 194J, technical consultancy services are liable for TDS FTS, assuming that it is an FTS, fees for technical service. Fees for technical service include consultancy service. So, it is an FTS. So, if it is an FTS, you have to deduct TDS at the rate of 2%. So, I am making you payment of FTS, I am supposed to deduct TDS at the rate of 2%. But you are saying that I am going to assessing officer for lower deduction certificate under 197. So, you went to assessing officer and you have brought a lower deduction certificate from assessing officer and the assessing officer gave you a lower certificate of 1%. So, now am I supposed to deduct TDS at 2% or 1%? 1%. But there is one more problem. You have not filed the return for the last 2 years. Check. And your TDS for the last 2 years is more than 1 lakh rupees. So, now here is the problem. That if the other person has not filed that, now 206 AB will apply. If the other person has not filed the return for the last year, we don't have to check last 2 years also. Only last year we are supposed to check. There is an amendment made by Finance Act 2022. Only last year is to be checked. Earlier it has to be last 2 years. Only last year is to be checked. So if the last year's return is not filed and if I am making you payment and if the TDS is 50,000 or more, then I am supposed to deduct the TDS at the applicable rate, twice the applicable rate or 5%, whichever is higher. So what is the applicable rate in this case? By default, applicable rate is 2%. But by applying the lower deduction certificate, now the applicable rate becomes 1%. So what is twice of 1%? It is 2% compared with 5%, whichever is higher, and therefore the answer will be 5%. So we are supposed to deduct TDS at the rate of how much percentage over here? At the rate of 5%. Is it clear to all of you? I hope it is clear to all. Beautiful question it is. Now the third question is a very, very simple question, nothing great as such. That Shalini is purchasing some house of how much? Of 60 lakhs, but the stamp duty value is 82 lakhs. So if you are purchasing a house of 50 lakhs or more, then you are supposed to deduct TDS under 194IA at the rate of 1% of the sale consideration or the stamp duty value, whichever is higher. So Shalini is liable to deduct TDS at the rate of 1% of 82 lakhs. So nothing great as such. Okay. The next question is a question based on transfer pricing, a good question, but a simple question, nothing great as such. In transfer pricing, the very first thing which we need to establish is the relationship of associated enterprise. Now, Shahi Private Limited is an Indian company and there is one company, Sumi Inc., which is a Japanese company. Now, The Shahi is wholly dependent on the raw material which is imported from Sumi. So we all know that if one entity is dependent on the raw material for 90% or more on the other entity, then both of them are associated. Here Shahi is not dependent at 90%. Shahi is wholly dependent on the raw material of Sumi, therefore both of them are associated enterprise. This is the first thing which you have to write in the question. Now the second thing is, pay attention please, here the real journey starts. Pay attention. This is Shahi which is in India. Okay, Shahi is in India. Pay attention. I'm just highlighting with different color. Shahi is in India. Okay. Sumi is in Japan. Now what Sumi is doing? Sumi is selling to Shahi at 30 crore rupees by applying a markup of 20%. Okay. Whereas Sumi is selling to unrelated party at a markup of 10%. So Sumi is selling us at a higher rate and Sumi is selling to third party at a lower rate. Okay. So we are supposed to follow CUP method over here, comparable and control price method. And we are what? We are purchasing something from our associate enterprise. So what is the cost? The cost over here will be 25 crore. How I got 25 crore? 30 crore is the total price and there is 20% markup on that. And therefore, if I do that 30 crore is 120%, therefore 100% is how much? That is cost is how much? It will come to 25 crores. Therefore, my cost is 25 crores. Okay. Now, can I directly apply 10% on this 25 crore? No. There might be some functional differences between the two. And the functional difference is this. There is only one function. Shahi was allowed to use the brand name of Sumi. So, Shahi, who is Shahi, the Indian company, is allowed to use the brand name of Sumi. But unrelated party is not allowed to use the brand name. So, if Sumi is allowing Shahi, that is the Indian company, to use the brand name, then it will charge for that brand name also, na? Why it will not charge? It will include that brand name also in the cost, na? So the cost will further increase by 90,000 rupees. 90 lakh rupees, not 90,000. It's 90 lakh because it's 90 lakh written over here. So Sumi is charging me 25 lakhs, but Sumi should also charge me 90 lakhs more. Yes or no? Because I am using the brand name of Sumi, so I have to add back 90 lakhs. So once I do this, I'll get 25.9 crore. And on that, now I will apply the arm's length margin. On that, I will apply my arm's length margin, that is 10%. That will come to 28.49 crores. Therefore, what is the real price? The actual price was 30 crores. Arm's length price is 28.49 and the differential amount is 1.51 crore. This is the first part of the question. Now, what is the second part of the question? If the TPO has enhanced the income by 2 crore, suppose TPO enhanced the income by 2 crore, can I get the deduction of 10 AA on that 2 crore? No. You cannot get the deduction of that 10 crore. You cannot get the deduction of that 2 crore under 10 AA, not allowed. Because there is a proviso under 92C subsection 4. First proviso to 92C subsection 4 which says that if the officer increases the income by increasing the arm's length price, then on that increased income you cannot claim chapter 6 and 10 AA. That is not allowed. On that increased income it is not allowed to claim chapter 6 and 10 AA. Not allowed. Okay. And the last one. Will Shahi Private Limited be liable for penalty under reporting? Yes. They will be liable for penalty for under reporting of income. Why? Because it is written very clearly in 270A. That if there is an underreporting of income, it will be considered as a misreporting. It will not be considered as a normal underreporting. Yes, only in one case you will be exempted. That is, if you have reported the transaction, if you have filed the report, etc. There are 2-3 things which are mentioned in section 270A6. If you follow those things, then the penalty will not be imposed. But if you do not follow those things, and if the officer finds some income, some arm's length price which is increased by officer, he will also impose what? Penalty under 270 at the rate of that to 2%, 200%, not 50%. Okay. So this is what this question is all about. It was a good question, but a lengthy question for 6 marks. It's a lengthy question, very lengthy. Anyways, let's come to the next question. The next question is based on what? Is based on your recent case laws, which are there in the recent judicial updates of ICI of May 2023. If you have been through the judicial updates of May 2023, you would be able to easily answer this question. Now, the first question says that, let me answer you. The first question can be answered without a case law also. There was an assessee who was supposed to, he has deducted the TDS, and after deducting the TDS, he has failed to deposit the TDS. So, the company has deducted the TDS but failed to deposit it. Okay, fine. Within the time prescribed. Now, the company later on deposited the TDS along with the interest before receiving any notice from the income tax department. So, before the income tax department can react and send the notice, the company has paid the TDS. Now the officer wants to launch prosecution under section 276B. Can prosecution be launched? No, it cannot be launched. Because the condition to launch prosecution under section 276B is the assessee should not have paid the tax. If he has paid the tax, he has paid the interest, He has deducted the tax. He has deducted the tax before the department can even identify the case. Then in that case, 276B prosecution cannot be launched. Okay. The next question is also based on recent case law, and also there was a case law which was we have done a lot of time earlier. Does the tribunal has the power to do what? To recall its own order? No, the tribunal does not have the power to recall its own order. Max to max, a tribunal can review its order. Sorry, it can rectify its order under 254 subsection 2 if there is a mistake apparent from record. And the third question is also based on a recent judicial update. The second one was of Reliance Telecommunication, which is there in our book also. And the third one is based on the ICI's latest judicial update. If you have gone to the latest judicial update of ICI, you would easily understand that what exactly this is. So even if you don't know the third one, it's okay. You have to attempt any two. You could attempt the question number 1, question number 2, if you don't want to attempt all 3 of them. Anyways, there was an option, internal option in question number 5. Okay. Now, question number 5B. What is question number 5B? Now, this was a very interesting question. Very interesting question. Huh? It is a very interesting question. Why, sir? This question has lot of issues. What exactly this question was all about? Let me first of all talk about 3 people over here. There is one person, Kiwi Inc., which is a non-resident who is engaged in manufacturing and selling of mobile phones. There is another company, Alpha Inc., who is just like Amazon. It's a website owner. It's an e-commerce operator. And there is one more company, Gamma LLC, which is also what? Manufacturing of printer. Now, none of them have what? Have a permanent establishment in India. None of them have permanent establishment in India. The question says that discuss tax implication in the above case scenario as per the Income Tax Act 1961. Now, it may be a mistake and it may be correct also. Why it may be a mistake? Let me tell you. What will happen to this? Let's see. Kiwi has sold 80,000 mobile phones. Now, 15,000 mobile phones are sold to person who are resident in India. Now, what are you? I'm not getting into the question, but I'm telling you the thumb rule of this question. In this question, you have to test whether equalization levy is applicable. At the same time, you also have to test one more thing, that whether significant economic presence will be applicable. That is, if the sale in India is of more than 2 crore rupees, then it amounts to significant economic presence and 911 will be attracted even though there is no business connection. It doesn't matter. Business connection is not required. Is not required. So you have to test these 2 aspects over here. This is what this question is all about. So in the first case, in the second case, third case, fourth case, fifth case, all the cases, you are supposed to check these things, whether equalization levy is applicable or whether business connection will be applicable, significant economic presence. So this is what this question is all about. Now, the next question and the last question is a very I don't know how can they ask such kind of questions for CA final exams. They have asked you the limits of SFT, Statement of Financial Transaction, 285BA. How can one remember the limits? Nevertheless, it was there in the syllabus, you are supposed to remember. So we are supposed to give 2 answers. We are supposed to tell whether the transactions will be reported in SFT, and if yes, you have to categorize which person will report, like in the first case. There is one person who is purchasing bank draft. He has purchased 5 bank draft of 3 lakhs each. So total he is purchasing 15 lakhs. Will bank report it? No. But sir, for bank draft, the bank's limit is 10 lakhs. Yes, it is 10 lakh, but if it is purchased in cash. So if I go to bank and if I purchase a bank draft of more than 10 lakh rupees in cash, then bank will report that. But if I'm buying through my current account, then bank will not report. So in this case, SFT is not required. Okay. I hope you understood. Second case, you have purchased some time deposit of 7 lakh first, and then you have renewed some time deposit of 5 lakhs. Whether SFT is applicable or not applicable. Again, you will ask a question. Sir, in SFT section, it is written that if you purchase time deposit of more than 10 lakh, the respective person has to report. Yes, but that 10 lakh does not include renewals. So this renewal will not be included in 10 lakhs. So you only have to consider the fresh time deposit. The fresh time deposit is only 7 lakh. Therefore, SFT is not applicable. Third case. If you make a credit card payment in cash of more than 1 lakh or other than cash of more than 10 lakhs, then the transaction will be reported by the respective authority. So in this question, you are making a credit card payment in cash of more than 1 lakh. I'll show you how. First, you are making 19,000 into 4, 78,000. Then you are making 13,300 into 3, that is 39,900. So if you make a total of both of them, it crosses 1 lakh. You can check. Okay. So cash payment should exceed 1 lakh or other than cash payment should exceed 10 lakhs. Either of the case, you are supposed to file SFT. Okay. And the last case, which I made a slight mistake in the Hindi review also. Here, I don't want to make that mistake. In Hindi review, I made this mistake. That Mr. Z has purchased 2 lakhs rupees goods in cash. He has purchased some garment of 2 lakh rupees in goods in cash from Mr. Arora, Mrs. Arora Designer, Who is liable for what? Who is liable for 44AB. So I made a mistake over there. It is not 2 lakhs, it is more than 2 lakhs. So if Mr. Z would have purchased more than 2 lakhs now, then SFT would have been applicable. On exact 2 lakhs, SFT is not applicable. By mistake, I said that in the review. So you can go and check such minute point they have asked. They have asked on the borderline. Exactly the limit lies on the borderline. They are putting exactly 2 lakhs, putting you on 2 minds, whether 2 lakhs was covered or not covered. Covered or not covered. So 2 lakh is not covered. If it would have been more than 2 lakhs, then a person who is liable, this comes in the last category. Then the person who is liable for tax audit is liable to collect, is liable to report the transaction. So if I'm Mrs. Arora and if I'm liable for tax audit, and if you are giving me 2 lakh rupees in cash, then I'm not supposed to report. If you are giving me more than 2 lakh, then I'm supposed to report. So that's what this catch is. The next question is something which I searched everywhere in the study material, but I was not able to find this question anywhere. It was very, very, very difficult to find this question anywhere. So this is the question which most of you might have left. This is purely based on what? Logic. Purely based on conceptual studies. I have told you in the class also there are a lot of fundamental principles of taxation law, or for that matter any law, which one has to keep it in their mind. I have told you a lot of principles. I have taught you a lot of principles in class, like all those principles, some are more related to that principle. They have asked a question over here. So I'll just repeat the principles which I have said in class. Generalia specialibus non derogant, principle of vicarious liability, actis non facitrenum nisi mensit rea, principle of ejusdem generis, principle of contemporanea expositio. Do you remember that these terms? Yes or no? While I was teaching you the theory topic of peremptory norm in the chapter of interpretation of tax treaties, there I have told you all this principle. So this question, I am not saying it is exactly based on those principles, but if you are aware of what exactly the principles of law are, then you will be able to answer this question to some extent. At least you will be able to write something logical. Otherwise, obviously this is an out of syllabus question here. They have not put this particular question in the study material, but nevertheless. And the last question is also based on what? It is theory. We have done all these things in class. You can go and check our easy notes also, colored notes. Pacta sunt servanda, I have said you all this in class. General rule of interpretation, mutual agreement procedure, etc., etc., etc. That you have to go to the respective tax authority and request them. And if they don't solve the matter within 2 years, then you have to go for what? You have to go for international arbitration, so on and so forth. All those things we have done in Article 25. So last question is generally theory only. So this last question was absolutely theory. That is the trend of the ICI in most of the attempts. The last question will be generally based on theory or GAR questions or theory questions, or last few topics, model convention, BEPS and interpretation of tax treaties. So overall, if I have to give a review to this paper, that out of 5, the difficulty level, it was 4. Or maybe 3.5 to 4. And if you have made an attempt of 75 to 85 marks and 90 marks, it is a great attempt, according to me. 55 to 65 marks, it's a reasonable attempt. You can get 50 marks. Below 60, if you have attempt, then it is very difficult to get marks. Below 60, then you might come at borderline. So you just check where exactly you have attempted. Okay. So that's it from my side. I hope you all have liked this review. If you have liked this review, share it with your friends also who wants to cross-check their answers. But you need a lot of courage to watch this particular video. To watch this video, you need to have a great amount of courage, because this video can give you sleepless nights. But nevertheless, you should have such kind of you should have that kind of capacity to hold such kind of things in your life. You should try to face problems in life. This review might give you a problem, but you should be able to face that. I hope you all have, I cannot say you all have enjoyed the review. Most of you are going to abuse me in the comment box by saying that, sir, why have you put the review? It is my duty to put the review. It is my duty. Now, whether ICM, I don't know when ICI will bring the suggested answer. They don't bring suggested answer for 3 months, 4 months. Yeah. They don't bring suggested answer till the next attempt also. So it is my duty to give my review from my side. So again, it was not a complete review as such. It was just an overview of the paper. It was not a very great and detailed review. I don't think so. It was a great and detailed review. It was just an overview which will give you some idea that what is the exact, if not exact, what is an approximate marks that you are going to score in your exams. Okay. So take care all of you. Till then, goodbye all of you. Take care and see you soon. Bye all of you.